Today, we're diving into portfolio management, and we're going to see why it's one of the most important ideas in all of finance, all through the lens of a true story about how fortunes were made and then completely, devastatingly lost.
So let me just start with a question for you. What if you bet your entire retirement, every single dollar you've ever saved, on just one company stock? For a lot of people, this wasn't just some scary thought experiment. It was their reality.
And to really get why this matters so much, we have to talk about the cautionary tale of Enron. It's maybe the most powerful example out there of what happens when you put all of your financial eggs into one single basket.
You have to understand, Enron was an absolute rock star of a company. For a whole decade, from 1990 to 2000, it wasn't just doing well, it was crushing the market. We're talking a 27% return every year on average, when the rest of the market was doing 13%. If you worked there, you honestly felt like you had won the lottery.
And this wasn't just a job. People really believed in the company. Take someone like Roger Bruce, a retiree. He had his entire $2 million nest egg, all of it, parked in Enron stock. Why? Because to him and so many others, it felt like the safest bet on the planet. And Roger was far from alone. By 2001, employees had a jaw-dropping $1.3 billion of their own retirement money in company stock. That made up over 60% of their retirement accounts. And here's the really critical part. They could have sold it. They were free to diversify, but they chose not to. The company was just doing too well.
And then it happened. In just 1 year, the unthinkable. The stock price went from about $90 a share all the way down to nothing. Zero. And that $1.3 billion in retirement savings, it was just gone, wiped out almost overnight.
The Enron story is just a brutal lesson, but it's one we all need to hear. It perfectly illustrates that first, most famous rule of investing: don't put all your eggs in one basket. And that simple idea, that's the heart and soul of what a portfolio is all about.
So how does it actually work? Well, just look at this. Imagine you put all your money in one single stock. Your journey is going to be a wild ride. Crazy highs, terrifying lows. That roller coaster? That's risk. Now look at what happens when you spread that same money across 5 different stocks. You're aiming for the exact same return, but the ride is just so much smoother. It's a whole lot less stressful.
Right, this is why they call diversification the only free lunch in finance. In this example, just by spreading your money out, the total risk of your portfolio drops to just 72% of what it would be holding a single average stock. Think about that. You've gotten rid of almost 30% of the gut-wrenching volatility without giving up your expected return. It's an incredible trade-off.
Okay, and this is a really big but, diversification is not some magic shield. It's amazing at protecting you from one company blowing up, but it can't save you when the entire market decides to take a nosedive. So in what you might call normal times, say between 1993 and 2000, different markets around the world kind of do their own thing. The US might be up, Europe might be flat, Asia might be down. Spreading your investments globally really helps smooth things out when this is happening. But then look what happens when a real crisis hits, like the 2008 financial meltdown. Suddenly, everything moves together. It doesn't matter where you're invested, the US, Europe, Asia, it all goes down in flames at the same time. In a true global panic, there's just nowhere to hide, and the benefits of diversification get a lot smaller. Okay, so knowing all of that, how do the pros actually do this? How do they manage money in a disciplined way that takes emotion and just pure guesswork out of the equation? Well, it really comes down to a simple, repeatable 3-step plan.
It all starts with the planning. This is where you actually write down your goals in a formal document called an investment policy statement. It's your blueprint. Then comes the execution. That's the fun part, where you actually go out and build the portfolio based on that plan. And finally, you have the feedback loop. This is crucial. It's where you're constantly monitoring, rebalancing, and making sure you're still on track to hit your goals. It never really stops.
And this exact process is what the biggest investors in the world use. But what's so fascinating is seeing how that first step, the planning, can lead to portfolios that look completely, radically different from each other. Let's check out a tale of 2 very different portfolios.
Just think about it for a second. Should a university endowment that's literally planning to be around for hundreds of years invest its money the same way an insurance company does when that company might need cash tomorrow to pay out a claim? No way. Of course not. And their portfolios show it.
So first up, let's look at the Yale University Endowment. Their timeline is incredibly long. So what do you see? A huge chunk
almost 60% is in what they call alternatives. This is stuff like private equity, venture capital, real estate, things you can't just buy on the stock market. They can afford to be patient and wait for these riskier bets to pay off big.
Now let's switch gears and look at MassMutual, the insurance giant. I mean, it is a night and day difference. Their portfolio is almost 80% in safer income-generating things like bonds and loans. Why? Because their number one goal isn't crazy growth. It's making absolutely sure they have the money, right now, to pay their policyholders. It's all about safety and stability.
So here's the best part of this whole thing. You don't need to be a multi-billion-dollar institution like Yale or MassMutual to build a properly diversified portfolio. Today, the tools to do this are available to pretty much everyone.
And the magic ingredient here is something called pooled investments. This is just a fancy term for things like mutual funds and exchange-traded funds, or ETFs. They basically pool money from tons of investors, which lets you buy a slice of a huge, diversified portfolio with a single click. It's that easy.
Now, even though they both give you diversification, they're not exactly the same. The biggest difference is pretty simple. ETFs trade all day long on an exchange, just like a share of Apple stock. A mutual fund, on the other hand, only gets priced and traded once, at the end of the day after the market closes.
Now, within these funds, you've got one more huge choice: active versus passive. Active managers are trying to be heroes and beat the market. Passive funds just try to match the market. And this chart, wow, this chart tells a huge story about fees. Passive funds manage about a fifth of all the money out there, but because their fees are so incredibly low, they only bring in 6% of the industry's revenue. That difference is money that stays in your pocket, not theirs.
So I want to leave you with this final thought. Whether you've thought about it this way or not, your money is almost definitely already in a portfolio. It's in your retirement plan, your savings account, somewhere. So the real question is, do you actually know what's in it, and do you know why? Understanding these principles is really the first step toward taking control of your financial future.